There is a charge coming out of your super every single month, and most people have no idea it exists. It never shows up on your payslip. It quietly eats into your retirement balance. It is insurance taken straight from your super account. Today, I am going to walk you through exactly how to find it, check whether you actually need it, and switch off the bits you do not. By the end, you will be able to do this yourself in about 20 minutes. Let me show you the scale of this. Australians pay around $6.8 billion a year for insurance through their super funds, according to research from Super Consumers Australia reported by the ABC in 2025. The same research found about 1 in 4 Australians do not even know what insurance they have, and many do not know they have any at all. That is a lot of people paying for something they cannot describe. Here is why this matters for your retirement. Super Consumers Australia estimates that young Australians alone are paying about $1.9 billion in excess premiums inside super every single year. That is money being drained from balances for cover people do not need, cannot use, or already have somewhere else. AMP calls this insurance erosion, where premiums quietly reduce your savings more than they need to. The good news is it is completely fixable, and it is your money to control. Think about what those small premiums become over time. AMP suggests your total insurance premiums inside super should generally stay under 1% of your salary. If you earn $80,000 and you are paying 2% instead of 1%, that is $800 a year being overspent, according to AMP. Now, if that $800 stayed invested in your super for 30 years at a 7% return, it could grow to roughly $75,000 by retirement. Small leak, big puddle. Step 1. We are going to audit every super account you own, including those old employer funds you forgot about. Log into each one through the fund's online member portal. Find the section called Insurance or Cover. Write down 3 things for each account: the type of cover, which is usually life, total and permanent disability, and sometimes income protection, the sum insured, and the premium being deducted from your balance. MoneySmart, run by ASIC, walks through exactly where to find this. Most people are shocked when they see the premium for the first time. Step 2. Now do the maths. Add up the total premiums across all your funds, then compare it to your salary. Industry guidance cited by AMP suggests your premiums should generally not exceed about 1% of your annual income. So if you earn $90,000, that is around $900 a year as a ceiling. If you're paying more than 1%, do not panic, but do flag it. It usually means you have duplicated cover sitting across multiple funds, which is the single most common problem we are about to fix. Step 3. Choose one fund to be your main home for both your savings and your insurance. Here's the key thing people miss. You generally cannot practically claim overlapping benefits from several funds for the same event. So if you have life and TPD cover in 2 funds, you are paying twice for protection you can only really use once. Pick the fund with the cover that best suits you, then we will switch off the duplicates. This duplication is exactly the erosion problem the 2019 reforms were designed to target. Step 4. This is the action that saves you money. In the funds that are not your main fund, cancel the insurance you do not need. Most funds let you do this through the online portal, by phone, or with a downloadable cancel insurance form as MoneySmart and AMP describe. Be deliberate. Only cancel what you genuinely do not need. Get the cancellation confirmed in writing, then check your next statement to make sure the premiums have actually stopped being deducted. That is your proof it worked. Step 5, and this one protects you from a costly accident. Under the Protecting Your Super reforms, insurance is cancelled automatically on any super account that has received no contributions or rollovers for at least 16 months, according to MoneySmart and EPRA. So if there is a fund where you actually want to keep the cover, you need to keep it active. Either make a small contribution or formally tell the fund you wish to maintain your insurance. Then check back after a month to confirm the cover is still in place. This is how you keep what you need while cutting what you do not. Now I have to flag the flip side because this is where the danger lives. The same reforms that cut waste have also left some people accidentally uninsured. ASFA estimates that about 5,000 Australians a year now die without any life insurance cover through super since the reforms, meaning their families miss out on roughly $670 million in death benefits every year. ASFE also found around 11,000 people a year miss out on about $1.5 billion in TPD benefits. So this is not about cancelling everything. It is about keeping the cover you genuinely need active. Let me knock out the biggest myth. People tell themselves the insurance in their super is free. So there is no harm leaving it. It is not free. Premiums come directly out of your super balance, which means less money invested and compounding for your retirement. That is exactly why Australians collectively pay $6.8 billion a year for this cover, and why young Australians are wearing $1.9 billion of it as pure excess, according to Super Consumers Australia. Free it is not. Silent, yes. Second common mistake, especially for older members, Insurance Inside Super usually has an age cap. According to MoneySmart, TPD cover typically ends around age 65 and life cover typically ends around age 70, though it varies by fund. So if you are in your 60s, you might be paying premiums for cover that is about to expire or no longer matches your situation at all. Always check the age caps in your product disclosure statement before deciding what to keep. Do not pay for protection that disappears next year. Let us run through it fast. 1. Audit the insurance in every super account, including the old ones. 2. Add up your premiums and compare them to 1% of your salary. 3. Pick one main fund to hold your cover. 4. Cancel duplicated or unnecessary cover in the other funds and confirm it in writing. 5. Keep any essential cover active by making a contribution so it is not cancelled after 16 months of inactivity. 20 minutes of work, potentially 6 figures back in your pocket by retirement. That is the whole playbook. If you do just one thing today, log into your super and find the insurance section. You might be surprised what is in there. If this helped, hit subscribe, because next we are breaking down how to consolidate multiple super accounts the right way without losing the cover you actually need. Remember, this is general information only, not financial advice. So check your own product disclosure statement before you cancel anything. I will see you in the next one.